In less than 24 hours, we're going to find out whether markets want to go bullish or bearish in their next move. It's thanks to the Federal Reserve, the dot plot, and this man here, Jerome Powell. On top of that, coming up in today's show, we've got Chipotle's 50-to-1 stock split. Are there any other opportunities out there? Supermicro's new issue of shares, the all-time high close for the S&P 500, Bitcoin's crash or correction down to the first key level, and of course, what the bonds market is telling us about the next move for markets. The results might surprise you. Today, we're discussing stocks, commodities, and cryptos together. Well, welcome back, everybody, to the Daily Show where we talk about markets around the world, macro, lead indicators, and the hottest charts. My name's Tom, and if you love markets like we do, remember to subscribe and hit that bell icon. It really does help us out. And a massive shout out to everyone that's been subscribing and commenting recently. It's been great to see the community with so many great ideas and opportunities. Let's get started with what happened over the last 24 hours. Of course, AMD entered into bear market kind of correction territory, which takes it into a few stocks that have done this recently. And Tesla held on to some of the previous gains. But it's not really there that I want to talk about. So let's get started by talking about the big news story, which is, of course, Bitcoin and the $8,900 price tag. During the alt season that's coming up, you're going to need to be very careful about where you're holding your money and what you're doing with it. This is a story that happens every single crypto boom, and you just need to always remember risk management is absolute when it comes to everything to do with crypto. Chipotle shares reach an all-time high, and they went after hours even further, thanks to a 50-to-1 stock split. There's a couple of other opportunities that I believe could be on the horizon for some stocks. Pause the video here, let us know in the comments down below, and we'll feature you in the next video, as I do think during this particular run, there's going to be quite a few stock splits coming. Let's also bring it back to the community for a second here. I gave 3 opportunities to kind of see some key demands for potentially crypto and Bitcoin over this particular correction. Now, generally a correction is between 15 and 30%. And you can see here that we've got 26% of people voting for the 62K, which we hit. And then we've got most of you seem to be thinking that an upwards of 30% correction is going to happen to 51,850. Very interesting. If it does hit that level, could be a point where people will be certainly doing some technical analysis on the charts. More of that coming up later on. Let's go over the market though. It was home builders out in front, and this kind of bodes well for the market to move forward realistically. But we did have some defensives. Some of my favorite sectors, or our favorite sectors right now, energy and utilities, have been moving through, and it takes us to a 5-day average move that is actually quite defensive and inflationary in nature. XLE, certainly an inflation-based stock, agriculture overall, and then of course defensive stocks like utilities, healthcare, and even financials were the best performers over the last 5 days. You might have thought with semiconductors, it certainly hasn't been. What about the charts? Well, let's take a look at one of the key ones. We'll do the rest later on. And this is, of course, the S&P 500 into today's FOMC coming. So this is going to be a big deal because, of course, we got the highest daily close on record, just nudging out these other points, but it's still within our daily resistance. Now, this is also a call resistance, and we know between 5175 and 5200 is a positive gamma switch environment. If we manage to get through 5200, look at in a moment, we're probably going to squeeze higher, 5250, 5300 for day traders, for people that are bullish in the market. That will be a very positive sign. Is this the first time we've seen something like this? Not really. When we've had these kind of gap up events in this current bullish market, we've tended to lead higher. Generally speaking, to stop a market like this, usually you need a pretty decent pull, and that usually is some kind of Wyckoff based strategy where you get kind of a bunch of highs, false breakouts, and then rally over, making that kind of distribution circle. So far, we haven't seen that, but let's take a look at the key levels together over the next 24 hours. 5175, 5200 remain very, very important. And of course, 5090, as we've reported here, this is where the bears start to take control of the market. The daily 20 moving average would be closed below, the first time since the October run, and the trend line sitting behind, which is this red line here, would also be hit. Below 50-50 should bring the swing traders in, and they'll be looking at under 5K and possibly even a 4,700 correction at that point, which would still put us in a bull run, but it would be a pretty sweet opportunity for those dollar cost averages out there. And I'm sure a lot of you guys want that. But the reality is, for now, let's take a look at the smaller time frames. We'll jump into the 5 minute. and we'll have a look at how the actual session ended up playing out. And you can see here that it was pretty much just buying throughout the session. And after it broke through some of these key levels, such as 51.58, it basically went bullish on the intraday. So here's the big breakout. This one then centered into 51.75, 51.80. And this was an actual level that is part of kind of like our day trading masterclass setups. So it's a pretty common setup. It was in the direction of trend. And if you had taken it, you would have been pretty happy with yourself. Overall, the US 500 is at a critical resistance, and this is pretty much normal. Ahead of any kind of big news event, you generally see markets rally to a resistance or a support. A lot of people are probably hoping it was going to be down at the 50.90 level, but I think it's going to be fireworks over the next 24 hours. So stay tuned, and we're looking at what the bonds market is telling us very soon. Let's now go over to the options world. So, of course, we talked about the idea that there's a positive gamma switch when we get past that 51.75. You can see it kind of moved up to 51.78.5 here in terms of expiration. And if we move through, look at all these strikes that are going to need to be hedged. So pretty much what will happen is dealers will be forced to buy into the market to hedge off their books, and this will push markets further and higher. It's pretty much what's been going on all year so far, and there's been no switches. Now, there are some interesting levels, such as the HVL here being at 51.30, but really I think it's that 50.90 zone that will actually trigger the bears to be in control of the markets, and then we'll move, I think steadily down. It'll probably be quite fierce if it does happen, but let's take a look at what the ODTEs say. So here is what's happening for the 20th, the 21st, and obviously moving forward. And you can see here that kind of when we're taking a look at what's most likely going to occur, underneath that 50.20 is going to need to be hedged off. So you can see here 51.20 actually with the most amount of puts. So if we do end up selling off for the session during the FOMC day, I could see a little bit of hedging starting to occur to the negative side. And then if we get through 5100 through the next session, which is obviously the 21st here, that's where you're really going to see that huge negative gamma shift in the markets. For now, that hasn't happened, but these are the key levels that you're going to have to be looking at. And I thought we'd include another one here today, which is basically just a flow map for the session. And what it's showing you is that the best two levels, which we pretty much knew over the last 24 hours, were going to be 51.10 or 51 kind of 80, 90. These were the two kind of like magnets for the potential session and what happens. And in this case, it went to the bull side and not the bear side. But if you were aiming for 51.10, that would have been an awesome place to be looking for buys through the session. And if you were shorting into it, I wouldn't have blamed you. Both looked good. It just so happened that it crossed up and it went towards the 5100 kind of an 80 zone. All right, let's go over the VIX now for a session. So basically the VIX has been going steadily down. It may go volatile. Obviously, we expect it to really only start spiking if we go below 50.90 on the S&P 500, and we're looking for a 15 to 16 breakout. Now, unless we get a daily close really above 16, I'm not too excited about being a super bear in the markets at this stage, and that's just because you don't really have that corrective tilt. The VIX has been very low for a long time, and as it remains underneath the 16 zone, it is better to look at single stocks and sectors moving forward. Just a reminder, if you want to follow us in any other socials or sign up for our newsletters, etc., you can do so in the links in the pinned comment down below. Let's now take a look at presidential cycles. Now, we've talked a lot about this. This is the overall presidential cycle, including the first, second, third, and fourth year. And in some ways, we're actually above the general cycle. You can see here that we had a awesome rally in the first year. We sold off to give us back down to the mean reversion, which is pretty standard. The second year is usually a sell-off year. And then we rallied up. But it's this October rally all the way to now that's starting to outperform. And you can see it's basically taken us to where we'd usually be during other cycles at the end of the actual period, basically when the elections come. So what that's kind of leading us into thinking is that we may be going into a chop city where we basically grind higher, come down, grind higher, go everywhere. This is just tracking the last 100 days to see the most correlated markets. And you can see in pretty much all of the correlation markets, they did end up grinding higher except for this one over here. And this was a tumultuous point. So I think it's still single stocks and sectors that are probably the best picks in the markets right now. Let's now take a look at some changes here in sentiment. Now, this is the Bank of America Global Fund Manager Survey, and no one thinks anything's bad anymore. Look at this. No landing has now become a big thing. 23%, hard landing now at only 11, which it's been for a while, and soft landing has actually decreased, and all of those people have gone into no landing. So are they justified in such comments? Well, let's take a look at some of the history. And of course, here is another one from Bank of America showing that risk appetite is the highest since November of 21, but it's still nowhere near some of those really peaky, frothy periods. March of 21 was one of the wildest markets I think I've ever seen in my personal trading career, where we just had anything and everything going ballistic. And if you haven't traded that period, you might want to go back and look at history, because if you look at the likes of PayPal, Square, I don't know, any of them, Virgin Galactic, all of those stocks were just absolutely ballistic. And you can really see what a super frothy market truly does look like. Now, a lot of people are bringing up this one to me, which is households. And of course, everyone's taking on lots of debt. In fact, taking on debt faster than before the financial crisis. Now, you might think, wow, take a look at this. Look at this debt going on. This is a bad thing. Unfortunately, we are growing based on debt. So look, is this eventually going to come back and kick everyone's ass? Probably. In fact, it is going to kick everyone's ass. However, this is fairly normal to see a growth of debt. It actually is technically good for current growth parameters in the markets. And what you're looking for now is delinquencies. So here's another one that obviously people are checking out, which is commercials. Now, commercials have been discussed now for, I would say, around 18 months as being the major problem in markets. Again, if we know about it and everyone's looking at it, it's unlikely to be the problem. Remember, they call it a black swan event because it might be in clear vision, but no one's discussing it. Currently, everyone still talks about everything to do with commercial property. I doubt that's where the problem's going to be. And instead, we're going to be needing to look at delinquency rates improving. Now, Goldman Sachs has put out their most recent delinquency rates, and you can see here that they are rising. However, they're not back to scary periods just yet. And on top of that, they don't expect them, according to their survey, so we'll have to find out and track it in the future, they don't expect it to rise that much more from where it currently is. Now, if it does, that's going to be a problem because, of course, debt is increasing in both credit cards, in housing, in everything. It eventually becomes a problem, and that's why you're seeing actually a reduction on rates, even though we've got no rate cut, especially in the housing sector. Shout out to the mortgage brokers down there. Put it down if you're a mortgage broker. Let everybody else know that that is pretty much what's happening. It's a little bit easier to get a loan than it was maybe 6 to 8 months ago. Let's take a look at now what's going on here in terms of payroll growth. We know that non-farm payrolls is one of the big numbers, and really this is probably what's going to drive a rate cut. Why is that? Well, of course, if unemployment actually starts to spike, that generally allows the big Federal Reserve to do some rate cuts. And this is Goldman Sachs' expectation for the rest of the year. We will be tracking unemployment. It's probably the most important factor, even though it's lagging in terms of what's really going on underneath the hood from a rate cut perspective. You can see here most people are concerned about higher inflation. That's now become the number one issue again. And you can see the huge spike up here in 2024 March compared to February and January. Now, last time we saw the market falling off because rates were so high. This time, markets don't care. It's in plain sight. People are kind of discussing it, but not as much as you would think. And we're only just starting to see people talking about copper and oil. Funny that, isn't it? We have been all together for quite a few weeks, but now everyone's on that train and it's already had some exceptionally nice moves. This is Goldman Sachs' expectation for the GDP growth for, of course, the economy moving forward. And all of this is leading into why you're seeing these higher prices on markets. We'll talk more about that as we look to forward growth in the future. But a lot of it's going to come back down to what the Federal Reserve says. And obviously the next 24 hours, do we break up and see a real rally here? Or are we going to actually break down and see that correction move? This is a bit of an indicator as well about why the market is kind of feeling good about everything right now. This is US rail traffic, and you can see actually the total traffic is increasing. Now, that's kind of good in terms of the data. It's taken here from March 9th, 2024. But overall, the internals, sometimes rail traffic is a great reader of what's going on in the markets. And you can see here that there has been an improvement, obviously not in coal, but there's been an improvement in some of the other areas. Interesting here, petroleum and petroleum products up 16.4%. And we're also seeing that metals as well up. So overall, rail traffic is up. We'll track this moving forward throughout 2024. So make sure to subscribe. Some other quick charts I want to go over here. New York Stock Exchange Composite. You can see here it's broken out. Some people call this the inverse head and shoulders. Down here you can see And this is, again, a longer term bullish positive sign for markets and the rallies that are going on right now. As we've spoken about, it is possible to see a forward PE easily go past 25, and we're currently sitting around 20. So remember, the trend is your friend until the very end. And I don't really like that statement too much, but what I do like to do is we have been talking about the 20 daily moving average for a long time. Until that's really broken through on the S&P and those other key levels, we just have to continuously go single stocks and sectors for this point. Where could the opportunities be if we do grind higher? Well, the opportunities most likely are going to be in stocks that you haven't looked at yet. Dividend yield is relatively cheap versus history. You can see here the forward PE of high dividend yield factors stocks compared to equal weight S&P 500 looks like it's kind of double bottoming. Now, it's been down here for a while, so it's just a bit of an idea, but there's going to be mid caps, small caps, and you would think dividend stocks that are going to look a little bit tastier moving forward. Another one of my favorites, which I've been crapping on about, is of course gold stocks. And although they didn't do well over the last 24 hours, I think we're at a turning point here. As you can see here, central banks around the world are purchasing up. And this is because, in my opinion, we're in currency war. And basically what people are doing is trying to back it versus gold. And I think gold is going to be a pretty decent winner over the next couple of years. Obviously, take that with a grain of salt. Make sure you make your own decisions and stuff. But I've been kind of vocal about talking about I have a $3,000 target on the next 12 to 18 months for it. Now, I do need rate cuts to make it happen, but we'll see whether that occurs. This is the week post OPEX in terms of generally how it trades. Wayne's obviously broken down the data. 5 up, so it's possible. 18 down. If it's going to go down, it needs to do it quickly because, of course, the FOMC is coming. In terms of corrections, are we due one? Absolutely. I'll bring this chart up again. 3 days now, I guess, in terms of since the last correction, and 67 on average. So we are well overdue a 5% correction. We're not due maybe a 10% plus yet, if you can believe it, but that's where it's important. Let's go over the biggest trades. So MSTR the other day, I just want to bring this up again, was obviously huge amounts of dark pool activity and huge amounts of large trades, profit taking for sure. The stock has since got crushed from that level. And the reason I bring this up is because there were some positives. Obviously, we saw Tesla finding base the other day. That means that 160 to 163 could be a very interesting level. And there's been a little bit of, a little bit of bites there. And if it comes back down to that level and we get another big circle and huge transaction going through, it's a good sign we're probably based off. So we'll be watching that. And there wasn't really too much else other than the Qs holding their defended zone again. And we talked about this. The way the Qs look at the moment, we'll look at it very soon on the charts, is it's kind of got this basing. And each time it comes down there, we've got big circular transactions. Speaking of transactions, the systematic flows of CTAs continue to kind of hover everywhere. Here's the update of the NASDAQ. So is it on a new low? No, it's actually bounced up. Still making a series of lower highs and lower lows. And I think a large update over the next coming sessions will be had, especially if we get flow towards the downside. S&P 500 still remains incredibly elevated, so that's up there. And just remember, these are the key news events for your week. I've circled them here, posted them over on our X account, FOMC projections, and then, of course, Fed Chair Powell being annoying on Friday, and everything else to do with flash services PMI, and a lot of ECB, a lot of Eurozone business. NVIDIA got the biggest bump, I guess you would say, in terms of call volumes, 1.22 times 90-day average. We also saw some big drop-offs in SMCI. Unfortunately, a lot of people probably caught on the wrong side of that trade. And I think a lot of people also caught on the wrong side of MicroStrategy. In terms of retail, we did see another very low day in options trade overall. Expect the FOMC day to be a huge one. There's a lot of structure there, where basically we're going to see a huge amount of expiration of options this week, which will all hedge towards the FOMC event, and we'll see what happens after that occurs. Retail was 31% of the transactions, and I think everyone is like the calm before the storm basically here. Is the storm going to be bullish or bearish? We'll have to find out. High yield junk bonds. Let's get into the bond discussion and further into the charts. And here we have basically bonds telling us everything's cool. Now, basically, why do we look at high yields? Because high yields are going up and rates have actually been going up. That is unusual. That's kind of telling us that there's still a huge risk appetite in the markets. This is a coil. We need high yield junk bonds down if you want to be bearish on markets. And if you're bullish, if you keep seeing high yield junk go up, that's a great sign for the markets. Some other reads that we've got as well. One of our best reads here, which is basically options in the bond market and what's going on in terms of yields. we're seeing here a drop to a new low. Now, this usually is the predictor of markets to go actually down or up. In this case, they continue to float down. You can see here overall, this has been a huge kind of market change for it. We haven't really seen any upticks. These are the upticks we got last year and this year, and even in February with that little bit of a pullback. This is the uptick that we expect. At the moment, it keeps going down. So we'll update you over the next 24 hours to see if that's changed. Our bond indicator as well is floating around in the coil as well. So there's nothing to change here in terms of bonds. Basically, across the board, the bonds market is either complacent, which it usually isn't, or it's saying and signaling, oh, we might be still rallying through this market. I'd like to see an update over the next 24 hours for this for sure. Let's look at the yields, of course, 4.77%, pretty much the yield you want to be watching. Semiconductors versus SPY, also important. And we're at that key resistance. We're going to find out if the market goes like this, then we're probably looking at actually rate cuts coming on the horizon, although we'll see. And if it goes through, that could still be a bit of a straw that breaks the camel's back. We'll have to see what the Fed has to say. S&P versus the central bank liquidity. Central bank liquidity actually still partially on the rise, and world central bank liquidity remains steady. So what this is telling you is that it's not like they're sucking out enough out of the market in terms of liquidity and support. So no wonder the markets are feeling pretty positive still. Treasuries has been dropping. Again, we still are bullish on treasuries over the next 12 to 18 months, but that obviously needs rate cuts. And at this point, we're just sitting around that support. We've seen previous buying here, but I haven't noticed any huge dark pool or large transactions yet. I expect that to come through after the FOMC event. So let's now take a look at commodities. This is something that we've all been tracking together, and we've been early, which is excellent. And of course, most people are now starting to catch up with this and starting to talk about copper breakouts, oil breakouts, etc. It always pays to be a pig if you can be in markets, to be able to recognize the price action and the breach outs. And of course, we did that quite well together, specifically on these. So with copper breaching out, it's hit its first resistance into the FOMC event. I expect this to be a fairly volatile time for it. It could pull back to 3.95, then bounce through, and a 4.4% breach out. That's going to be a huge level, and it probably marks a huge turning point for commodities around the world if it's managed to do it, becoming less of a flash and more of a sustained kind of growth for metals and mining. What about growth versus value? So we talked about that a little bit before, and it looks like this market has been starting to show that value has been better than growth in recent weeks. Now, for now, the trend is still up, and of course, this trend line, 20 moving average, key 1.88 ratio, all of these things need to be paid attention to, but we will be watching it moving forward. It's an important one for the next huge rotation, which is going to be better. Remember, the market internals with VIX underneath 20 are better to be looking at. Single stocks, sectors, that's how you get the better performance. And with VIX under 20, it's a great time to be looking at those. With the dollar being at call or resistance zones, you can see here support becoming resistance. The dollar is at a critical level, and we can't really be sure which way it's going to move to next. At the stage, it's been going on the downside. Obviously, yields going down should push dollar lower. If yields broke through that 4.77 on the 2-year, expect the US dollar to bounce up. Gold is kind of similar, waiting for the event. Again, yields down, probably gold up. If it breaches through this flag, I think we're going to $2,300 an ounce. And as I've said a few times on this channel, I have a long-term positive look on gold. Even though it might seem like a boomer metal, I do think that in this stage, it is a very good one that could be going okay, especially in a rate cutting cycle moving forward, and the fight between the BRICS and, of course, the SWIFT systems. Let's take a look at oil, hit into our resistance level. Very happy with this. I expect it to have a fairly large reaction over the next 24 hours, and most people are now talking about oil in the market. So no doubt that's why it's at resistance at a critical point. Chipotle, huge rally, big rally after hours, and a stock split on the horizon. This is all the types of catalysts that you dream of if you're in a stock. And it's been a while for this one. Another candidate I think could be coming up is NVIDIA. So for bulls of NVIDIA, of course, stock splits down below is a big deal. And that usually leads to a 5 to 15% gain in the stock in terms of in front of the actual split announcement. What other ones did you have in the comments though? We'll go through them tomorrow and focus on a few. Adobe, which is one of the stocks of the week so far that we found on the Monday open, continued its little bit of a dead cat bounce up. It's going to probably struggle around the 528 mark, but certainly a level we will be focused on. And Adobe is just more of that opportunity on the horizon. Now let's move over to Hershey's. Now, if you've been following cocoa price, it's getting wild. But Hershey's is actually basing off. Big transactions going through recently, a huge monster volume, you can see it here, and a breach of a flag pattern. Now, if you know anything about patterns, this kind of looks like a Wyckoff style accumulation, and it's been very oversold for quite some time. So it's one of those position-based trades, but I like Hershey's. I think it's an interesting level. Hey, I'm not that much of a fan of their chocolate. Maybe you are down below, but regardless, it is a very nice technical trade. If you like Hershey's, let me know though. XLU, what's going on here? Another big movement out. Still tracking XLU for probably about the next 20 to 25 days, and I'm still bullish on it. And of course, it could be a flag that breaches out. If the market goes down, I kind of expect utilities to hold. If the market goes up, I kind of expect utilities to perform okay. It might be a boring market, but it's all about risk reward. NVIDIA bounced off the 850 options level. This is pretty much the put support at this stage. A breach below 850 is going to open up, hedging towards the next level, which is around $780. So for now, it's just sideways, and this is exactly what we expected the stock to do after its huge sell the other day. If you're a dollar cost averager, a long-term investor, maybe you like that level. SMCI is another one. Now, this actually goes gap up, gap down, island reversal. Now, I kind of said over here that I expected to bounce and then expected to go sideways. I guess so far so good. Is this an overreaction? 1,200 down to 900. That's a pretty big discount. You're looking at 30% off. If you're a big fan of SMCI, maybe you like this zone. On the daily, you're probably looking for a bounce above 922, a new high to be formed, and then some day traders are going to be looking for that quick bounce on it. But if it doesn't get above the high, it could go a little bit lower first. 800 specifically being the last kind of support, about 820. HSI, nothing changes on our Chinese market kind of positions. We're moving forward with the idea that it's 2 steps forward, 1 step back. Specifically, tech stocks, they usually bounce us out of the bottom. And we're looking at, of course, gamma stocks, things like the AI kind of beneficiaries in the Chinese market at this stage, KWeb, CQQQ, those types of things. US 2K, and it's still in the ascending channel at the level of support. Now, this is totally different. There are 3 markets in the US that most people look at. Of course, the Dow used to be the one we used, but now it's US 2K and NASDAQ. And you can see here that we've got a support, no doubt, but it's still a critical support. If it breaches through here, it's signaling further downside in the small caps, and they've been really struggling, turning for the first time negative again since early February of this year. You can see the NASDAQ is the same. It's still making a series of lower highs and basically equal lows. 17,788, still worth setting an alert there. If we take that, that's going to mean the strongest previous sector in the market is weakening. SMH versus SPY, which is of course semiconductors, all of those things starting to lead towards the downside. Be very careful there. And then of course we've got Bitcoin. Now everyone is focused on the key levels. I've already talked about them in our poll, but I think these are the main 3 zones. And it's pretty normal for Bitcoin to do this. A negative 15% is very normal, and it actually goes up to negative 30%. If you look at previous cycle or cyclical periods, it's always had these 30% type sell-offs. Just go back to 21, and if you actually mark it out and we go over here and we have a look at 21, you'll notice there's this big sell-off here. And if you take a look at the percentages overall, it's about that 30% percentage. So that would take us down to around 51, 52K. And then we've got the 61.8 sitting at around 42,000, which is going to be a very, very good zone. If you're asking me what my opinion is this halving cycle, I think that all of these levels should be pretty interesting and pretty decent. There's obviously a lot of risk in the crypto markets, but anyone that's been involved in them for some time knows that these things do occur, and you've got to be on the lookout for them. Leverage is sometimes incredibly dangerous in this market. Money can be made and money can be lost in a click of the finger. Thanks very much for watching. If you enjoyed today's video, remember subscribe, smash that like button, guys. Put some comments down below on what you think the split is going to be moving forward, some split candidates so we can focus on them. And of course, follow us on the other socials. Thank you and bye for now.